Head and Shoulders Chart Pattern. In this video you will learn what the Head and Shoulders pattern is, how to identify the pattern, and how to trade the pattern. The Head and Shoulders pattern is a trend reversal pattern. There are two types of Head and Shoulders pattern: the standard Head and Shoulders pattern found at the end of an uptrend, and the inverse Head and Shoulders pattern found at the end of a downtrend. In this video, we will look at the standard Head and Shoulders pattern and how you can trade it. Due to the Head and Shoulders being a reversal pattern, you want to look for it after a big up move. The pattern is identified by its left shoulder, head, right shoulder, and neckline. Now that you know what the pattern looks like, let us look at two ways to trade the pattern. Once you have identified a completed pattern, with a formed right shoulder and price breaks below the neckline, you can look to go short. It is a good idea to wait for a candle close below the neckline before you look to enter a short position, as it confirms that the bears are in control and avoids false breaks. You can place a stop loss above the right shoulder in case the pattern fails and price continues moving up. To calculate the profit target, measure the distance between the head and the neckline of the pattern, and then extend this distance from the neckline in the direction of the breakout. Another way to trade the Head and Shoulders pattern is to wait for price to break and close below the neckline, as in the first example. This is noted as broken support. However, instead of entering after the close of the candle, look for the price to retest the neckline before selling, as this level is now seen as resistance by many traders. This will give you a better entry level and will allow for a smaller stop loss, as you can place the stop loss above the new resistance area. The profit target is found using the same method as before, where you would measure the distance between the head and the neckline of the pattern, and then extend this distance from the neckline in the direction of the breakout. So far, you have learned that the standard Head and Shoulders is a bearish reversal pattern that occurs after an uptrend. You can trade the Head and Shoulders pattern by waiting for a candle to break through and close below the neckline. The stop loss would go above the right shoulder, and the take profit is calculated by measuring the distance between the head and the neckline of the pattern, and then extending this distance from the neckline in the direction of the breakout. You can also trade the Head and Shoulders pattern by waiting for the price to break through the neckline, also known as broken support, and then entering when price retests the neckline as resistance. The stop loss would go above the resistance level. The take profit is calculated by measuring the distance between the head and the neckline of the pattern, and then extending this distance from the neckline in the direction of the breakout.